Dr. O, I want to talk to you about, well, first of all, let's start with some census data. So last week, new residential construction report came out for May 2025, and it is suggesting that perhaps the brakes are being tapped on new building. And as you and I were talking over the past couple of hours, as we were doing a little bit of show prep, you think that that's perhaps a bit foreboding?
Yeah, I mean, look, historically, housing has always been a kind of leading indicator of things to come in the U.S. economy. If you think about it, I say this all the time, housing is the heartbeat of the U.S. economy. More than, 30 to 50% of your monthly expenditures are basically your housing costs. And so for some people, and so it plays a huge role when the housing market starts to slow down, when prices, and by the way, prices are forecasted to fall, right? We just had a Case-Shiller report on yesterday that showed basically price growth is easing faster than expected. And so basically there's a couple of things. The first thing is, this wealth effect. Well, when homeowners feel less wealthy, they go out and spend less. And so, of course, that shows up in the economic, in consumer spending. And of course, the large chunk of U.S. economic growth. And so that you end up with a slowdown in economic growth. You also have all of the services that go around, with housing, right? So when sales are down, when home sales are down, you also get, fewer, real estate agents are not doing as well financially. So they don't go out and spend a ton of money. Builders are pulling back, and you're seeing in data already, builders have pulled back significantly. Housing starts were down 4.6% when compared to a year ago in May, right? Total housing starts. So builders pulling back means, well, they're spending less on building products and materials and components. It also means they're hiring fewer workers. And so all of that, just compounds, right? And it means a big chunk of the U.S. economy is slowing down very rapidly. And again, historically, the data tells us that, housing is extremely responsive to, changes in interest rates, right? And it's usually the first one to go before the U.S. economy goes under. So I'm not predicting a recession yet. I don't think that's my baseline forecast, but I see a slowdown, and I see the labor market poised to weaken further in the months ahead.
What are the other pieces of data that we should be looking at? And I want to kind of jump into the broader market. We talked earlier this week with, personal consumption, and the PCE. I mean, you're a keen watcher, obviously, of a number of different data points. What's the next data point that you're looking toward for info?
I mean, it's the PCE right now, right? So we're going to see the PCE coming out this week. I think that's going to be a big one. But ultimately, I'd love to see whether or not I'm really focused on whether or not initial unemployment claims continue to rise. Right? We're seeing more and more people are staying unemployed for longer, because hiring rates are very low. And so if you continue to see the unemployment claims continue to rise rapidly, the unemployment rate could be poised to increase. And unfortunately, the unemployment rate never really increases in a linear fashion. It tends to tick up a little bit at first, and then it goes. And so that's what I think the Fed, is going to be having to watch out for. And that's potentially why I'm a big proponent of, a preemptive rate cut, in July.
Yeah. Can we talk about that just for a moment, just to kind of catch everybody up? I mean, at least within sort of this episode, we had talked, you and I, for months about rate cuts, and it didn't look like it was coming. What is in the data overall that you're seeing that's suggesting? Because Christopher Waller, one of the governors, I mean, is somebody whose opinion you really respect and whose ideas I think you follow along with very, very closely. Said, I mean, it's like, I think I want to paraphrase. I certainly don't want to quote because I do not have the quote in front of me. He intimated that we were going to see a cut at some point here soon. And we think it's probably a quote.
Well, yeah. I mean, he defended the case for July rate cut essentially. And yeah, I mean, inflation's at 2.1% right now. I mean, we're going to see the PCE. There's so much downside risk that perhaps, the balance has shifted towards, maybe a cut is more appropriate at this point. And it could be a rate cut. It could be a one-time rate cut and then pausing again to see how the economy reacts to that rate cut. I think that is very, very smart, given that we know from the past that once the labor market goes, then it's very hard to contain, layoffs, right? When businesses are uncertain about the future, they pull back and they pull back significantly, in order to kind of protect themselves, to save themselves and live to fight another day. Right. Very few businesses will forecast the downturn, will see demand slowing and continue at the same pace. Right. They'd rather pull back and see if they can kind of survive a tough time. Right. And usually the way they do that is to protect the profit margins is to basically cut workers. And we really don't want to see that. And so I think, remember the Fed's mandate, inflation and unemployment, but also financial stability. And the last thing we want is to see, inflation being already so close to the Fed's target, right? There's just no reason to let the unemployment rate, rise, significantly from here.
Yeah. Well, I appreciate your thoughts as always.